Good morning, everyone. I'm going to give a few more moments, but just wanted to pop on just to let you know that we'll be starting uh, pretty close to 10 when the course is supposed to begin, but I'm going to give a few more folks the chance to log in, so I will be back with you. If you have any questions or anything comes up, just be sure to use the question through the go-to meeting prompt since we have everybody on mute. Thanks. All right, good morning, everyone. Thank you so much for joining me today. I am excited to bring to you this 1 hour CE on the best practices for Section 125 plan success. So we do have a ton of information to go through today. And while we do have everyone on mute due to the webinar format, please be sure to submit your questions through the GoToWebinar prompter, and I will try to get to them at the end, or at the very least, I will send out the questions with answers to everyone so that you'll have those. One other item is we will be sending out a copy of this presentation to each participant, so don't feel like you have to take feverish notes. There are a few slides that has a lot of information, so I want to make sure that you guys do have that available to you. All right, so I have to go over the CE instructions. Today's CE course has been approved for 1 continuing education credit in the state of Arizona. It is on the webinar. It is webinar based. In order to receive the credit for the full hour, we do need you to stay engaged with the course. And throughout the course, I will have a few polling questions that will require 100% participation in order to receive your CE credit. I will definitely give chance for everybody to answer that, but just want to make sure that you're aware that you do need to take those polling questions. So let's go ahead and get started. According to a 2017 annual employee benefit survey that was conducted by SHRM, the vast majority of organizations that responded to the survey offered health coverage to their full-time employees in 2017, which is actually the same level as it's been for the past 4 years. And nearly all of them paid at least a portion of the health coverage cost, with 16% covering the full cost. So I'm looking forward to seeing what the 2018 and 2019 results are as well. The study had also noted that a third, or 34%, were offering coverage to their part-time employees in 2017 as well, which was up from 27% in 2014. Now, although the majority of those employers shared the cost with those part-time employees, 8% of them did require the part-time employees to pay the full cost. In addition to these findings, employers are continuing to explore an employee benefit and tax advantage strategies with a focus on richer benefits, controlling healthcare costs, along with increasing employee participation within their healthcare strategy. The Internal Revenue Code 125 is the only means by which an employer can offer employees a choice between taxable and non-taxable benefits without the choice causing the benefits to become taxable. So as noted in that SHRM study, employers continue to offer more employee benefits to attract and retain talent. So in turn, successfully implementing a Section 125 strategy is smart business. So plans that can be offered via Section 125. Some of these are probably like, yes, of course. And then you may have some you're like, wow, I didn't realize, or vice versa on the cannot be offered. But obviously medical, dental, vision, your prescription drugs, life, both short-term and long-term disability, as well as AD&D plans, wellness, group voluntary life, FSAs, HSAs, dependent care accounts, and adoption assistance are plans that can be offered via Section 125. Now, plans that cannot be offered via Section 125 are group dependent life, HRAs, an Archer MSA, prepaid legal, transit and commuter benefits, and really just about anything voluntary. So voluntary life, dependent life, voluntary AD&D, your disabilities, critical illness and cancer, those voluntary plans cannot be offered via Section 125 plan. This slide is, well, really one of my favorites. It has a ton of information on it, a lot of valuable information all on this one slide. I will send out the hard copy of this piece to everybody that is in attendance along with your CE certificate, because it not only goes over what can be included in Section 125 plans, but it also goes through ERISA and COBRA. So basically it's kind of a compliance 101 for different plan types. So rest assured I will be sending that out to you guys as well. So this is going to bring us to our very first poll question. Again, remember you have to participate in the polls in order to receive your CE credit. So I will go over the question first, and then I will launch the poll, give everybody about a minute to respond, and then we will go over everybody's answers. So how can an employee receive pre-tax benefits? Is it A, the employee just needs to let the employer know that they want their deductions taken out pre-tax? The employer must set up a Section 125 plan, or C, none of the above? Let's go ahead and get this one launched. All right, everybody should be able to see it. Please be sure to vote or your answer on there so that we can make sure that you receive your CE credit. And I will give about, actually, it looks like everybody has voted. I think that one might have been a little bit too easy. So we'll go ahead and close that and share the results. Yes, absolutely. Everybody chose 100% the employer must set up a Section 125 plan. So we're off to a really good start. All right. We should be back now onto our screens. I've done everything correctly. Okay, here we go. Okay, so what are some key advantages for Section 125 plans to the employee themselves? Well, employees are allowed to pay for certain qualified expenses, medical and dependent care, on a pre-tax basis, therefore reducing income subject to payroll taxes and increasing their take-home pay. Because these benefits are free from federal and state income taxes, an employee's taxable income is reduced, which increases the percentage of their take-home pay, and because the pre-tax benefits aren't subject to federal Social Security withholding taxes, employers also win by not having to pay that matching FICA on those dollars. The key employer advantage is really, the tax savings piece of it. The employer saves money on all dollars that are run through a Section 125 plan because it reduces that employer's payroll. Accordingly, the employer doesn't not pay FICA or workers' compensation premiums on those dollars because amounts paid through a cafeteria plan reduce the salary base used to calculate those employment taxes. Now, with advantages do come disadvantages. For employees, employees cannot change their election unless there is a qualifying status change, like the birth of a child or marriage. Because a Section 125 also reduces income, it can reduce how Social Security and retirement benefits are calculated as well. Unused funds fall into that use it or lose it rule. And we'll go into some of the new rules, but many of you, I'm sure, are familiar now that we can now roll over a certain amount of funds if an employer so decides. But we'll go through that later on in the slides. Employer disadvantages include really, the cost and the compliance requirements of maintaining a Section 125. And then, of course, the risk of financial loss. And that's really specific to a health FSA because the employer is pre-funding or front-loading the dollar amounts that the employees elect. All right. A POP plan, so a premium-only plan, is the simplest form of a Section 125 plan. It allows employees to make premium contributions from their salaries before taxes are taken out. Therefore, we just talked about this, reduces their taxes and creates more take-home pay. Most companies currently have this POP set up through their payroll provider just because it is the simplest and requires little maintenance once it has been established. A flexible spending account, or an FSA, is a qualified benefit under an employer-sponsored cafeteria plan. The FSA allows employees to elect a fixed dollar amount from their paycheck to pay for qualified expenses. By electing dollars to be placed in an FSA, the employee is protected from being taxed on those expenses. These funds in these accounts can be used to reimburse the employee for eligible healthcare expenses, as well as dependent care expenses incurred by either the employee, the spouse, or the employee's dependents. The three types of FSA accounts are a health FSA, a dependent care FSA, and then a limited purpose FSA. The health FSA and the dependent care accounts are separate accounts. Employees can participate in either one or both, but money cannot be transferred between the accounts. The maximum contribution level for 2019 into the health FSA is $2,700. We're still waiting for the 2020 numbers, but health FSAs can reimburse expenses for employees and dependents, and an employee is not required to be covered by the group health plan in order to participate. So again, the employee doesn't have to be covered by that health plan in order to participate in the FSA, but the key is that they must be eligible to participate in that group health plan. So that's the biggest difference. Must be eligible, but doesn't necessarily have to participate. The IRS publication 502, or you may have heard it referenced as the 213D expenses, includes a list of some healthcare expenses that are deductible underneath an FSA. Most of these expenses can be reimbursed through an FSA, and examples of some of those are, vision expenses, deductibles, co-pays, prescriptions, dental services. Those can all be deducted. Now, although the maximum for 2019 is $2,700, that doesn't mean that an employer has to allow that full amount to be offered. So the employer has flexibility on how much they would like to allow the employees to contribute to the FSA. Now, we talked about some items that can be reimbursed. So here are some that cannot be reimbursed. Health insurance premiums cannot be reimbursed, long-term care, cosmetic items, vitamins, supplemental products of that nature. And then, of course, over-the-counter drugs can no longer be reimbursed underneath an FSA. The only exception to that, of course, is insulin. Now, they can be reimbursed for over-the-counter drugs through their FSA only if the doctor has prescribed that they get that medication. So the key here is that an employee will want to make sure that they save the prescription along with that receipt in case they ever need to substantiate that claim. Now, you've probably heard the term full cafeteria plan. This is where the employer makes a non-elective contribution for every eligible employee that enables them to spend the employer contribution to purchase any of the benefits offered within that cafeteria plan, like the ones I've mentioned on this slide. So as an example, the employer could say you have $300 a month to participate in the following options. In addition, the employee can contribute pre-tax dollars to purchase benefits that are greater than those that are offered by the employer contribution. But on the same token, if their benefit election is less than the $300 example, there would be the cash option available. What is a limited purpose FSA? It has the same maximum contribution level as an FSA. So for 2019, that's $2,700. The purpose of the limited FSA is to allow employees who are eligible and contributing. So there's the key word. If they are contributing to an HSA, a health savings account, they can still take advantage of the tax savings, but with limitations to only reimburse qualified dental and vision expenses. So that's going to take us now to our polling question number 2. An employee can commingle their FSA funds and their dependent care account funds. Is that true or is it false? I will get that launched. Everybody should be able to see it, so if you could go ahead and start voting, I will give it a few moments. Still waiting for a few more to vote. I don't want to close it down because that is how you get your CE credits. So I will give about another, say, 20 seconds. It's just hard because now there's silence, but I'm just waiting. So give it a few more moments. We're pretty close. All right, remember, if you haven't voted, that could affect your ability to get your CE certificate. I will go ahead and close this one out and share the results. So the question was, an employee can commingle their FSA and dependent care account funds. The answer is false. They are not allowed to commingle those funds. They are two separate accounts. So they must maintain separately. You cannot move funds from either one of those accounts to the other one. So the answer on that one was false. All right, let's go ahead. And hopefully you guys can all see my screen again. So let's move into dependent care flexible spending accounts. The key points of a dependent care account is that it can only be used for dependent children under the age of 13. So that includes daycare, summer day camps, after school care. But you can also use dependent care accounts for elder care for dependent parents, care for a disabled spouse or a dependent child, and then care-related services such as a visiting nurse can all be used through a dependent care account as well. The takeaway on this one is employees can't claim expenses through the dependent care account and on their federal tax return. So an employee cannot participate in the employer's flexible spending account on dependent care and then also claim that through the federal tax return at the end of the year. So each employee has to determine which is better for them. The maximum contribution to a dependent care account is $5,000. This hasn't changed forever. Unlike the health FSA that sees the adjustments annually, if an employee is married and filing separately, so if they're married but filing separately, they can only set aside $2,500 for the dependent care account. So one thing to keep in mind on the FSA is that is an annual limit, and on the dependent care account, it is a family annual maximum. So if they are married and filing separately, they can only set aside $2,500. Section 125 or has Section 137 included in there, and that's for adoption assistance. Adoption assistance may be included in a cafeteria plan, and there's language specific to the adoption assistance must be included in the plan document. So if an employer does decide to include this, they have to have specific language in that plan document. These programs provide employees with an exclusion from gross income for expenses incurred for qualified expenses in connection with adopting a child. Now, the key difference here is only federal income tax withholding is reduced under this program. So Medicare, Social Security, and FUTA taxes are not eligible. The Adoption Assistance Program will also allow an employee to stop those future salary deductions, but it will not permit an employee to recoup any amounts that were already taken out prior to the termination of a proceeding. Likewise, an employee can elect mid-year to start the adoption assistance deductions when a proceeding commences. So there's some key differences there. The 2019 maximum for adoption assistance is $14,080 for 2019. All right, so premium reimbursements accounts, those were no longer allowed after the passing of the ACA. However, the QSERA was signed into law by President Obama in 2016, and it allows an employer who does not offer a medical plan, so a group medical plan, and has under 50 employees to set up the QSERA to reimburse employees for qualified health plans purchased on the individual market or through a spouse's employer. Like other pre-tax plans, a plan document is required for this arrangement. Recently, 2 additional HRA plans were released that allow the individual health premiums to be reimbursed through the ICHRA, or the Individual Healthcare HRA, and that is for all size employers. And then the EBRA, which was the Accepted Benefit Health HRA for dental and vision expenses and premiums. Just like the QSERA and those other pre-tax programs, you have to remember that plan documents are required to maintain these policies. And depending on which of these pre-tax accounts that you utilize, they could be subject to ERISA, COBRA, and non-discrimination testing. So they each have their own individual rules, which I'm not going to go through those. We will have an HRA CE webinar coming up soon as well, so we can definitely tackle that because it's a lot more. Okay, so we're going to jump into some key components of Section 125 plans. Cafeteria plans must be established and administered, we've already kind of talked about this, in accordance with the IRS regulations under Section 125 of the Internal Revenue Code. The formal requirements of a cafeteria plan include a written plan document, which we'll dive into a little bit deeper. Participants must be offered a choice between cash and one or more qualified benefit, and all participants must be employees. An election to take a qualified benefit in lieu of cash must be provided to the employee by the beginning of the plan year. And only changes that can be made is if there is a change in family status. And contributions must not discriminate in favor of those highly comped employees or their dependents. So that's the key to a full-blown cafeteria plan. What is the key component of a written plan? So every plan has to have a written document. It's called the plan document. The plan document is a written document that describes the rights, benefits, and obligations under the plan, as well as the terms and conditions for the employer in administering this plan. Every employer who maintains a health and welfare benefit plan that is subject to ERISA must have a separate written plan document for each. One thing to remember, this is key, because does seem to be quite a bit of confusion through those. It is important to note that a summary plan description, or an SPD, a certificate of coverage, a summary of benefits and coverage, and a master contract is not a plan document. So merging all those together does not take the place of a plan document. That is a separate written document. The summary plan description is an important document that a plan administrator must provide automatically and free of charge to every participant of an ERISA-covered health plan. So where the written document is kept really by the employer and only provided as requested, the summary plan description does have to be distributed to each participant. And it must be given to them within 90 days of coverage, or 120 days of the plan's effective date. It does inform the participant of their benefits and rights under the plan. Now, the IRS created a series of tests that are designed to make sure that the rank and file, so your non-highly compensated employees, are able to take advantage of the pre-tax savings, and that the highly comped individuals don't use or select more non-taxable benefits. Is non-discrimination testing required? I get asked this a bunch. The answer is absolutely yes. It is required for all pre-tax plans to participate in the non-discrimination testing. The best practice is to perform non-discrimination testing before the plan year, in the middle of the plan year or before the last quarter. And the reason that you want to do this is if the employer fails that test, it gives the employer the opportunity to correct the reason for the failure. So for a plan to pass, they must be in compliance by the end of the plan year. So what that means is even if they failed during the plan year, so they ran the test in the middle and they failed, as long as they are able to pass the non-discrimination testing on the last day of the plan year, they are considered passed for the entire year. So it's always key to run those tests before the end of the plan year, just to make sure that no corrections need to be made. What are the consequences for not passing? Well, it includes the benefits for the highly comped individuals to be included now in their gross income. The employer must treat the amount of the highly comped employees' salary reductions as taxable income for their W-2 reporting and for income tax, FICA, and FUTA withholding. Think about an employer who hasn't performed non-discrimination testing on their plans for years. If they're ever audited and the plans do not pass the testing requirements, that could mean amended W-2s and amended tax filings for those highly comped or key employees. So I can't stress it enough. It is a requirement that needs to be done. There are different types of themes, if you will, in regards to the testing. So some testing are looking for eligibility, benefits, contribution and benefit testing, key employee concentration, more than a 5% owners, 50% average benefits. Again, you'll get a copy of the slide deck, so you'll have this information as well. But as you can see, the different pre-tax plans all have different testing that needs to be completed. As of right now, fully insured major medical and dental plans do not need to have any testing performed. There's rules that they should be, but the IRS notice from 2011-1, it says compliance is not required for those fully insured plans until government issues the regulations. So right now we're on a wait and see basis, but someday we may even have to do discrimination testing on fully insured plans once the actual guidance has been released. So we've talked about the different plans, the requirements of the plans. So let's now talk about how an employee gets reimbursed for their eligible expenses. An employee does need to submit a claim to their FSA administrator with proof of that it was an eligible expense and that it was paid under the code. Debit cards are now available for health FSAs and limited purpose FSAs so that the funds for eligible expenses can automatically be deducted. This helps to reduce or eliminate the need for an employee to file a manual claim for reimbursement. Pharmacies, doctor's offices, dentists, vision, and hospitals generally have special coding inside of their credit card machines that is recognized by the debit card as an eligible deduction. The employee, though, is still required to maintain records just in case they need to substantiate that expense, even if it was automatically approved through the debit card. Now, the amount that can be withdrawn differs by the type of account being offered. For example, dependent care accounts can only be reimbursed as the expense occurs and only up to the amount that was deducted from the employee's paycheck. Now, healthcare reimbursement accounts, on the other hand, the funds are available in full immediately on the first day of the plan year. So here's where employers bear the risk of an employee exhausting their FSA dollars and then leaving the company before all the payroll deductions have been contributed. Vice versa on that, though, an employee forfeits if they don't use all their funds, and those funds will go back to the employer. Understanding the options that help with the use it or lose it rule. So there's a grace period is available. The grace period allows an employee up to 2.5 months after the plan year during which unused benefits can be used. A run-out period allows employees to submit claims that were incurred in the plan but were not yet reimbursed. Now, the new provision, which I kind of mentioned it in the beginning, is the carryover. So health FSAs only allow for an employee to carry over up to $500 that can be used in the subsequent year. Now, again, that amount is subject to the employer. So the employer can decide which provisions they would like to put in place. They can also decide if it's up to $500 or if they want to use a lower amount. Now, a plan can have a run-out period and a carryover period, but cannot have a run-out period, cannot have a carryover and a grace period. So it has to be one or the other. And then, of course, we talked about this earlier, but the forfeited funds will go back to the employer or the FSA administrator, depending on how that's all set up. Okay, so now let's move on into compliance. So this is really some critical questions to ask your employers to make sure that they are in compliance. So we're going to start with the POP plan. These are simple, easy questions to ask an employer or a prospect to check to see if they are in compliance. 1, do you have a plan document? If they do have a plan document, have they ever amended it or verified that the administrative practices are consistent within that document? Is the document amended to allow for the marketplace and stability period plan changes? So if they have an older document, it may not be updated correctly. Have you renewed your medical plan early? Are you now offering an HSA? Because your plan document should be amended to include those as pre-tax deductions. And then, of course, have you completed your non-discrimination testing for your plot plan? So questions to ask on the health FSA or the limited purpose or dependent care account. If you offer an FSA, do you also offer a group health plan? You have to have a group health plan in order to offer an FSA. Is the FSA eligibility the same as the medical plan eligibility? Have documents been updated with the new limit maximums? So if they now allow for the new IRS maximums, have they updated that document? If they adopted that $500 carryover provision, did they remove the grace period provision? Because remember, you can't have both. You can have a grace period and a run out, or a carryover and a run out. Did you include FSA information and premiums in your COBRA notices? FSAs are COBRA eligible. If you did have an early medical plan renewal, did you amend your documents for that short plan year to coordinate with your new medical plan year? And then again, have you completed those non-discrimination testing? Next, you need to determine who is and who isn't eligible to participate in a cafeteria plan. Employees are eligible if they're a C Corp or a limited partner not receiving guaranteed payments, or if they're an LLC, but they are taxed as a C Corp, they are eligible. All other are no's for the employee, but dependents, there's some variations. And again, you will get a copy of the slide deck, so you'll have this information. One that we see the most and get the most questions about is S Corps, or more than a 2% owner. They and their dependents are not allowed to participate in a pre-tax program, so a Section 125 program. COBRA continuation requirements apply to the medical and the limited purpose FSA. And the rule on this one is that COBRA must be offered if the participant has more benefit dollars in their FSA than is required to contribute for the rest of the year. So let's take a moment to do an example on that one. $1,200 FSA elected for the calendar year. The participant terms in March, so March 31st is their last day. The participant has contributed $300 and has $900 more to contribute. COBRA would need to be offered if that participant has $900 or more left in their account. If less than $900 is left, so they've spent that amount of money already, COBRA would not need to be offered. The COBRA continuation coverage for an FSA is only through the remainder of that current plan year. COBRA does not apply to dependent care accounts or the adoption assistance plans. All right, we're up to polling question number 3. So let's go ahead and get that one launched. Compliance with the Section 125 requires a plan document and a summary plan description, a summary plan description, a summary of benefit coverage, and a master contract, or the SPD just needs to be provided within 90 days. So I will go ahead and get that one launched. Okay, you should be able to see that now. Go ahead and be sure to get your voting in so that we can ensure you get your certificate. Okay, going to allow for some more time. I can still see some votes coming through. I have a couple that have not voted yet, so I will give a little bit more time here. I will be wrapping it up in about 10 seconds. All right, so I'm going to go ahead and close. Looks like 100% voted. That's great. Let's go ahead and close the poll now, and then I will share the results. So the correct answer was A, A Section 125 requires a plan document, which is the document that employer keeps, and the summary plan description, which is required to be distributed to each employee. Common mistake on this one is that the summary plan description, the summary of benefit coverage, and a master contract make up the documents that are needed. And then the third one is technically it's correct. The summary plan document, oh, it looks like I had a typo in mine. The summary plan document must be provided within 90 days, but that does keep you in compliance. But the answer that we were really looking for was A, because you do need that plan document and that summary plan description. All right, we should be back onto the presentation again. So let's go over some best practices. Really, it's all about the tax savings. The employer saves 7.65%, which is Social Security and Medicare. The employee saves between 20 and 40%, depending on that employee's tax bracket. Just to reiterate, the FSA maximum benefit for 2019 is $2,700. Something to keep in mind is that there is a maximum benefit condition that is required within a Section 125 plan, as well as an availability condition. So just something to know and just to keep in mind. In some circumstances now, an employee can have a health FSA benefit greater than the annual maximum, so the annual maximum of $2,700. And how this can happen is if an employer makes a contribution to the employee's FSA, or if that health FSA has that carryover balance from the previous year. So there are instances where you'll see that an FSA balance may be higher than the maximum, and those are two instances where that can happen. Let's go through some case studies. I'm going to go fairly quickly just because I can see that our time is getting closer here. This one, they're all going to be pretty much the same. So we're going to look at an employee that earns $60,000 gross pay annually. This is one where they have the POP plan, so they have the premium only. They allow that the employee's deductions be taken out pre-tax for their benefits. You can see here the employee has an annual savings of $1,659. Here is how you can, basically we're going to continue to layer these. So this is a POP plan along with an FSA. This is just the FSA. Has an employee savings. So if an employee set aside $2,600, they would have a tax savings of $717. So if you take that backwards, that $2,600 is costing around $1,900 for them. Well, not exactly. This is one with an employer adding in the dependent care account, showing the tax savings of $1,308. And here we've layered them all together. So now you have the POP plan, you have an FSA, you have a dependent care. The employees participating in all of those, they're looking at about a savings of about $3,700. So using a Section 125 is a great way, excuse me, to be creative in your plan design and your communication with employers. You can set up an HSA compatible plan with a post-deductible HRA. So as you could set up let's say the HSA plan has $3,000 deductible. As long as you have the employee meeting that minimum deductible of $1,350, the HRA could pick up the remaining balance. So that's a great strategy. I'm seeing a lot more of those happening. An HSA with a limited use FSA, so still allowing for those dental and vision expenses. And then a percentage split HRA with an FSA. So you could have where the employee needs to meet the deductible first, then the HRA will come into play, and it's an 80-20 split. So the 80% by the employer, 20% by the employee, or different ways that you can set those up. Think about using technology and how to integrate that to assist and support your clients and their Section 125 needs. It's so much easier for an employee to follow a prompt, right, in choosing their elections. They can see what benefits will actually cost them. They can choose tutorials and videos. So I think that when you're looking at strategies for Section 125 or pre-tax programs, using technology to help with that discussion just makes complete sense. So what is next for employers? You need to ensure that they are in compliance, that they're communicating, and that they are distributing the documents. Questions again, right? Do you offer any health and welfare benefits? Do you allow pre-tax employee contributions? Do you have one of these pre-tax programs? Do you have that plan document? Do you have your SPD, your summary plan description, and have you distributed it to your employees? And then again, have you performed your annual non-discrimination testing? That takes us to the very end. I'd like to thank everybody for attending. Be on the lookout for a copy of the slide deck, that one form that had all of those different check marks and boxes, and is it ERISA, is it not ERISA, that sheet, as well as a copy of this slide deck. I will get to the questions. We have really coming up close. Actually, I guess we have a little bit of time. Let me see what this question is. There is one here. It just asked me if I could clarify what the acronyms are for QSERA, ICRA, and EBRA. So the QSERA is a Qualified Small Employer Health Reimbursement Arrangement, and that's for small employers under 50. And then there's the ICRA, which is the Individual Healthcare Health Reimbursement Arrangement, and that's one of the newer ones that was just announced, I believe, in July. And then the EBRA stands for Accepted Benefits Health Reimbursement Arrangement, which is also one of the new ones that just came out. Please feel free if you have any questions that come up. You guys can reach out to me, jvernon@primepay.com, or my phone number is 714-210-2107. Thank you very much for attending, and you guys have a great Tuesday.